In this video, we're looking at 3 stocks Cathie Wood is aggressively buying again after making a series of notable purchases that caught Wall Street's attention. You'll discover why one of the market's most famous growth investors is doubling down on these businesses despite recent volatility, and why these companies could be positioned to benefit from some of the most powerful long-term trends shaping the future. These are not businesses fighting for relevance. They are leaders in critical industries, protected by powerful competitive advantages, massive scale, and business models that could continue compounding shareholder value for years to come. Let's start with the first stock, Broadcom, ticker symbol AVGO. Cathie Wood is no stranger to volatility. After struggling through several difficult years, her investment style came roaring back in 2025. Her flagship growth strategies dramatically outperformed the broader market as investors once again embraced innovation-driven businesses and disruptive technologies. Now she is trying to accomplish something even more difficult: back-to-back years of outperformance. So far, the results across her ETFs have been mixed. Some of her funds have more than doubled the market's return, while others have significantly lagged. But one thing remains clear: Cathie Wood is continuing to put capital to work aggressively when she sees opportunity. And on Thursday she was particularly active. Among her purchases was Broadcom. At first glance that might seem surprising. Why? Because Broadcom had just experienced one of the most dramatic one-day declines seen among megacap stocks in recent years. Just one day earlier, Broadcom shares were sitting at an all-time high. Investors were celebrating the company's leadership position in artificial intelligence infrastructure, its extraordinary growth, and its central role in powering some of the world's most advanced computing systems. Then the mood changed. Broadcom stock plunged approximately 13% in a single trading session. The sell-off erased roughly $285.6 billion in market value. To put that into perspective, this was one of the largest single-day market capitalization losses among the market's biggest companies over the past 6 years. For many investors, a decline like that immediately raises concern. Cathie Wood appears to have seen something different. She saw opportunity. To understand why, you need to understand what Broadcom actually represents. Many investors think of artificial intelligence as a software story. Others view it as a data center story. But beneath both of those themes lies something even more important: infrastructure. Without the hardware, networking systems, connectivity solutions, and semiconductor technologies required to move enormous amounts of information, artificial intelligence simply does not work. Broadcom sits directly in the middle of that ecosystem. The company develops critical semiconductor products and infrastructure technologies that help power modern computing. As AI models become larger, more complex, and more demanding, the need for high-performance networking and advanced semiconductor solutions continues to rise. That trend is not slowing down. In fact, it appears to be accelerating. And Broadcom's latest earnings report proved exactly that. Despite the market's negative reaction, the actual operating performance was incredibly strong. During its fiscal second quarter, Broadcom generated $22.2 billion in revenue. That represented year-over-year growth of 49%. Think about how remarkable that number is. Growing revenue by nearly 50% is impressive for a small company. For a company operating at Broadcom's scale, it is extraordinary. Even more impressive was the performance of its AI business. The artificial intelligence semiconductor segment, which now accounts for nearly half of the company's total revenue, surged by an astonishing 143% year-over-year. 143%. That is not the type of growth investors typically associate with a mature infrastructure company. It is the type of growth often seen in emerging businesses during their fastest expansion phase. Yet Broadcom is producing those results while already generating tens of billions of dollars in quarterly revenue. The company's profitability was equally impressive. Reported net income climbed 88% from the prior year period. Adjusted earnings increased 55%. Revenue surged, profits surged, artificial intelligence demand surged. On the surface, this sounds like the type of report that should send a stock sharply higher. Instead, investors focused on guidance. This is where investing becomes interesting. Sometimes a company can deliver excellent results and still disappoint the market, not because the business is weak, but because expectations had become almost impossible to satisfy. Broadcom's outlook for the fiscal third quarter called for approximately $29.4 billion in revenue. That represents a substantial sequential increase and an incredible 84% jump from the same quarter a year earlier. In most situations, investors would celebrate guidance like that, yet Broadcom's stock had already enjoyed a tremendous run heading into earnings. The market wanted something even stronger. When expectations become elevated, a company can beat estimates, raise guidance, and still experience a sell-off. That appears to be exactly what happened here. What makes this situation especially interesting is that several Wall Street analysts actually became more optimistic after reviewing the report. Some raised their price targets. Others highlighted the strength of Broadcom's AI business. One analyst even upgraded the stock shortly after the decline. That tells you something important. The concern was not necessarily the business itself. The concern was valuation expectations following an enormous run higher. Even after the recent decline, Broadcom shares remain approximately 60% higher than they were just 1 year ago. Over the past 5 years, the stock has generated roughly an 8-fold return. That kind of performance naturally creates high expectations, and when expectations become elevated, stocks can become vulnerable to short-term disappointment. But Cathie Wood appears focused on something else. She appears focused on where the business may be heading over the next several years, and there are compelling reasons to understand her perspective. Broadcom benefits from a powerful combination of competitive advantages. First, its products occupy mission-critical positions inside complex technology ecosystems. Customers depend on Broadcom solutions for networking, connectivity, infrastructure, and semiconductor performance. Replacing those systems is rarely simple. That creates strong customer relationships and significant switching costs. Second, Broadcom benefits from scale. The company generates enormous cash flow, invests heavily in research and development, and possesses resources that allow it to remain at the forefront of technological innovation. Scale can become a competitive advantage in itself. Third, Broadcom's exposure to artificial intelligence extends far beyond a single product cycle. Many investors are focused on the current AI boom. Broadcom's opportunity may be larger than that. As AI adoption expands across industries, the demand for networking capacity, data transfer capabilities, and advanced semiconductor infrastructure could continue growing for many years. Broadcom is positioned to participate throughout that process. This is one reason many investors view the company as a pick-and-shovel play within the AI revolution. Instead of betting on which specific AI application becomes dominant, Broadcom benefits from the broader expansion of AI infrastructure itself. And that distinction matters. Predicting the ultimate winners among AI applications is difficult. Owning a company that helps power the entire ecosystem can sometimes be a more durable investment thesis. Of course, no investment is without risk. Artificial intelligence spending could eventually slow. Competition remains intense. Technology evolves rapidly, and after years of strong performance, investor expectations remain elevated. Those factors can create volatility. The recent 13% drop serves as a powerful reminder of that reality. But long-term investing often requires separating short-term market reactions from long-term business performance. When you look beyond the stock chart and focus on the underlying business, Broadcom continues to execute at an exceptionally high level. Revenue growth remains impressive, profitability remains strong, artificial intelligence demand remains robust, management continues to guide for substantial growth, and despite one of the largest one-day market value declines in recent history, many professional investors remain optimistic about the company's future. Cathie Wood clearly appears to be among them. Rather than viewing the sell-off as a warning sign, she viewed it as a chance to add to an existing position. That decision may ultimately prove to be right or wrong, but the logic behind it is easy to understand. Broadcom remains one of the most important infrastructure companies supporting some of the most powerful technological trends in the world today, and if artificial intelligence continues transforming industries over the coming decade, Broadcom could remain one of the biggest beneficiaries. That is why this stock deserves attention, not because it recently fell, but because the business underneath the stock continues operating from a position of extraordinary strength. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock Cathie Wood aggressively added to on Thursday is DoorDash, ticker symbol DASH. At first glance, DoorDash might seem like an unusual pick compared to a company like Broadcom. One operates in advanced technology infrastructure. The other helps deliver food, groceries, and other products directly to consumers. But when you look deeper, both companies share something important. They are platform businesses, and platform businesses can become incredibly powerful when they achieve scale. Before discussing the stock, it's important to understand why DoorDash matters. Many investors still think of DoorDash as simply a food delivery app. That view dramatically understates what the company is becoming. DoorDash has spent years building one of the largest local commerce logistics networks in North America. Its real asset is not the app. Its real asset is the network. Millions of consumers, millions of deliveries, hundreds of thousands of merchants, a massive fleet of drivers, an enormous amount of logistics data. and a technology platform that connects all of those pieces together. Once a network reaches a certain scale, it becomes increasingly difficult for competitors to replicate. More customers attract more merchants. More merchants attract more customers. More orders attract more drivers. More drivers improve delivery times. Better delivery times improve the customer experience. The cycle reinforces itself. That network effect is one of DoorDash's most valuable competitive advantages, and Cathie Wood appears to believe the market is underestimating the long-term potential of that advantage. The stock has certainly given investors a difficult ride. Over the past year, DoorDash shares have been cut nearly in half. That kind of decline naturally creates skepticism. Many investors see a falling stock and assume the business must be deteriorating. But that's not necessarily what has been happening here. In fact, some of the underlying business trends have been moving in the opposite direction. Revenue growth actually accelerated during 2025 after years of slowing growth. That is a significant development. Normally, companies experience rapid growth early in their life cycle and then gradually slow as they mature. DoorDash managed to reverse that pattern. Instead of continuing to decelerate, growth picked back up. That tells investors something important. Demand for the platform remains strong. The company is still finding ways to expand its addressable market, and management continues to identify new growth opportunities. One of the most interesting developments came this week when DoorDash announced upgrades to its advertising platform. Many investors overlook this part of the business. They focus entirely on delivery fees and order volume. But advertising can become an extremely attractive revenue stream. Merchants want visibility, restaurants want more orders, brands want customers to discover their products. As DoorDash's platform grows, advertising inventory becomes increasingly valuable. And unlike delivery operations, advertising revenue can carry significantly higher margins. That means it has the potential to improve profitability over time. The company has also been expanding beyond traditional food delivery. Last month, DoorDash reported well-received financial results and revealed a push into restaurant point-of-sale software. That may not sound exciting at first, but strategically, it is a very important move. Think about it from the merchant's perspective. The deeper DoorDash integrates itself into restaurant operations, the harder it becomes to replace. Instead of simply handling deliveries, DoorDash can become part of the restaurant's operational infrastructure. That creates stickier relationships and potentially opens the door to additional revenue opportunities. This is one reason many successful platform businesses continue expanding into adjacent services. Every new service strengthens the ecosystem. Every new integration increases switching costs. Every new product deepens customer relationships. DoorDash appears to be following that playbook. Of course, there are legitimate concerns facing the company. The market is not pessimistic for no reason. Investors have been paying close attention to several economic risks that could affect the business. One concern is consumer spending. When economic confidence weakens, consumers often become more selective about discretionary purchases. Food delivery can be viewed as a convenience rather than a necessity. That raises an important question. Will consumers continue paying delivery fees and service charges if economic conditions soften? Another concern involves fuel costs. DoorDash depends on a large network of gig economy drivers. Higher gasoline prices can place additional pressure on driver economics. If fuel prices rise significantly, maintaining an efficient and motivated driver network could become more challenging. Investors have also been watching geopolitical developments closely because energy markets can react quickly to global uncertainty. These concerns are real, and they help explain why many investors have become cautious. But Cathie Wood appears to believe the market's concerns may be excessive. There is a strong argument supporting that view. Despite the challenges, DoorDash remains the leader in a growing industry. Consumer behavior continues evolving toward convenience. People increasingly expect products to arrive quickly. Restaurants increasingly rely on digital ordering. Local businesses increasingly depend on online commerce. These trends did not begin yesterday, and they are unlikely to disappear tomorrow. In many ways, DoorDash is benefiting from a broader shift in how consumers interact with local businesses. The opportunity extends far beyond restaurant meals. Groceries, retail merchandise, household essentials, pharmacy items, and potentially many other categories in the future. Every expansion creates additional opportunities for growth. That is why investors should avoid viewing DoorDash solely through the lens of restaurant delivery. The company is attempting to build a local commerce ecosystem, and if successful, that opportunity could be much larger than many people currently appreciate. What's particularly interesting is that Wall Street expects revenue growth to remain strong even as profitability improves. Growth is expected to moderate somewhat next year, but moderation does not mean stagnation. Analysts still expect roughly 20% revenue growth. Many businesses would be thrilled to achieve that level of expansion, especially while becoming more profitable. That combination matters. Investors often reward companies that can simultaneously grow revenue and improve margins. It demonstrates operating leverage. It shows that growth is translating into stronger economics, and it suggests the business model may be becoming more efficient over time. This is where the long-term investment thesis becomes compelling. DoorDash is no longer simply a high-growth company trying to prove itself. It is becoming a scaled platform business with multiple avenues for future expansion. It has a recognized brand, a large user base, strong network effects, growing merchant relationships, expanding advertising opportunities, and new software offerings that could deepen its role within the broader commerce ecosystem. Those strengths do not eliminate risk, but they do help explain why Cathie Wood was willing to add more shares despite the stock's difficult performance. She appears to be looking beyond the next quarter. She appears to be focusing on where the business could be several years from now. And if DoorDash successfully continues expanding its ecosystem while improving profitability, today's pessimism could eventually look very different in hindsight. That's the opportunity Cathie Wood appears to see, not a struggling delivery company, but a platform leader building infrastructure for the future of local commerce. And if that vision plays out, investors who focus only on recent stock performance may be missing the bigger picture. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock Cathie Wood aggressively added to on Thursday is Coinbase Global, ticker symbol COIN. This is the most emotionally charged of the three positions, and arguably the most misunderstood. Because unlike Broadcom or DoorDash, Coinbase is not tied to physical infrastructure or consumer convenience in the traditional sense. It is tied to something far more volatile, the entire cryptocurrency market. And when crypto weakens, Coinbase feels it immediately. To understand why Cathie Wood is buying here, you first need to understand what has been happening beneath the surface. Coinbase stock has fallen nearly 2/3 from its peak last summer. That kind of drawdown is not subtle. It reflects a broad collapse in sentiment across digital assets. Bitcoin has been under pressure, declining meaningfully over the past year and losing further ground more recently. At the same time, the total market capitalization of cryptocurrencies has contracted significantly, dropping to roughly $2.1 trillion after a notable decline in the past month. When crypto prices fall, Coinbase does not operate in isolation. Its entire business model is directly exposed to trading activity. Coinbase is the leading online trading platform for digital currencies. When prices are rising, trading activity explodes. When prices fall, activity slows down dramatically. That is the core of the business, and it cuts both ways. This is why Coinbase can feel like a high beta version of the crypto market itself. When sentiment is strong, revenue can surge rapidly. When sentiment weakens, revenue can contract just as quickly. That volatility is exactly what investors have been experiencing recently. The company has already reported 2 consecutive quarters of declining revenue. Revenue dropped 22% in one quarter, followed by a 31% decline in the next. Those are significant decreases. But the more important question is not what has already happened, it is what comes next. Analysts currently expect the decline to begin moderating, with a smaller drop projected for the upcoming quarter. That suggests the worst of the revenue contraction may be stabilizing, at least in the near term. However, there is still a deeper structural challenge facing Coinbase. This is not just a cyclical slowdown, it is also a competitive environment that is evolving rapidly. Traditional trading platforms have made it increasingly easy for users to access cryptocurrency markets without needing a specialized crypto-native exchange. That creates additional pressure on Coinbase's market position. At the same time, investor enthusiasm for crypto assets has been uneven. Periods of excitement are often followed by sharp pullbacks, and that emotional cycle has a direct impact on Coinbase's financial results. But despite all of this, Cathie Wood continues to buy. The question is why? The answer lies in what Coinbase represents during periods of market expansion. When crypto markets are strong, Coinbase becomes one of the most profitable platforms in the entire digital asset ecosystem. Trading volumes rise sharply, transaction fees increase, user activity accelerates, and revenue expands quickly due to the scalable nature of the platform. This is not a traditional subscription business. It is a transaction-driven business with enormous operating leverage. That means profits can grow rapidly when conditions are favorable. The challenge is that the reverse is also true. That is why Coinbase remains highly sensitive to macro conditions and investor sentiment. But long-term investors often focus on a different question. not whether the business is stable today, but whether it can become significantly more valuable over time. And in Coinbase's case, that future is closely tied to the evolution of digital assets. Despite recent weakness, cryptocurrency adoption continues to expand globally. More institutions are exploring blockchain technology, more financial systems are experimenting with tokenization, more users are entering the ecosystem over time. These trends do not move in a straight line, but they do represent a long-term directional shift in financial infrastructure. Coinbase sits at the center of that transition. It is one of the most established and regulated entry points into the crypto economy. That position gives it both advantages and challenges. On one hand, regulatory compliance and brand recognition make it a trusted platform for many users. On the other hand, regulation also introduces complexity and cost, and competition continues to evolve. Still, Coinbase's scale matters. It remains one of the most widely used platforms for buying, selling, and storing digital assets, and scale in financial infrastructure can become a powerful advantage over time. The company's recent financial performance reflects the current environment clearly. Revenue has been under pressure. Profit expectations have been revised downward. Analysts now anticipate earnings per share to decline significantly in the coming year. Those are not encouraging short-term signals, but they reflect a market that is currently in a down cycle rather than a disappearing industry. This distinction is important because many of the most successful long-term investments in history have experienced severe drawdowns during cyclical downturns. The key question is whether the underlying system continues to evolve. In Coinbase's case, the broader crypto ecosystem remains intact. Trading still occurs, users still engage with digital assets, and the infrastructure continues to develop. The scale of the decline in crypto market value highlights how sensitive this ecosystem is to sentiment, but it also highlights something else. When sentiment eventually recovers, activity can return just as quickly. And when that happens, platforms like Coinbase can experience rapid rebounds in revenue and profitability due to their high operating leverage. That is the asymmetric nature of the business. Weakness on the way down, strong acceleration on the way up. Cathie Wood has built much of her investment philosophy around identifying assets with that type of asymmetric potential, high volatility, high risk, but also high potential upside if the long-term thesis plays out. That is what makes Coinbase so interesting in her portfolio. It is not a stable compounder in the traditional sense, it is a leveraged bet on the long-term adoption and maturation of digital assets. And while the short-term environment remains challenging, the long-term trajectory is still unfolding. Investors who only focus on recent revenue declines may see risk. Investors who focus on multi-year adoption trends may see opportunity. That is the divide. And it is exactly where Cathie Wood tends to position herself. Looking across all three stocks in this video, a clear pattern emerges. Broadcom represents infrastructure behind artificial intelligence. DoorDash represents the expansion of digital local commerce. Coinbase represents the infrastructure behind digital assets. Three very different businesses, but all tied to large-scale technological and economic transformation. That is the common thread. Not stability, not short-term performance, but exposure to long-term change. And that is what makes Cathie Wood's buying activity worth paying attention to. Not because she is always right, but because she is consistently looking where others are not focused. Before we finish, a reminder for anyone who wants deeper insights and ongoing analysis. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now the key question for you, which of these three companies do you believe has the strongest long-term competitive advantage? Broadcom, DoorDash, or Coinbase? And why? Drop your thoughts in the comments because this is where the real investor debate begins. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.